to today's VentureCrowd Morningside Co-Living Fireside Chat. My name is Brad Beh, and I'm a Senior Development Manager with VentureCrowd Property Services. For those who don't know, VentureCrowd is a digital investment platform for alternative assets, including venture capital and property. We have over 74,000 registered members who have invested over $312 million with us across a range of ventures since we started, with over $50 million invested last financial year. I think it's also what's important to know about VentureCrowd is that we're a purpose-driven business. That means we only work with companies that have purpose at their core, and the way we assess that is by ensuring that each company we have on our platform is addressing one or more of the United Nations Sustainable Development Goals. Today, we are thrilled to be speaking with Matt Fenn, Development Director with Co-Living Operator UKO, and David Whitting, Head of Property for VentureCrowd. Matt Fenn is Head of Development at UKO, driving the company's expansion across Australia. He collaborates with developers, investors, and family offices on co-living and build-to-rent projects. Previously, Matt was a manager at CBRE, where he facilitated over $700 million in development site and commercial investment transactions in metropolitan Sydney. He also has experience in corporate insolvency, distressed property transactions, and Matt is a licensed real estate agent with a commerce degree from Macquarie University. Welcome, Matt. David Whitting is a property development executive with over 30 years experience, including as Director of Developments for Brookfield Multiplex, Project Director for Laing O'Rourke, and Queensland Head of Grocon. David leads VentureCrowd's property team alongside myself and some other very experienced operatives. He specialises in acquisitions, disposals, and strategy for high-grade real estate assets across various sectors in Australia. So let's get to it. Matt, to start with you, co-living as a property class might be relatively unknown to a lot of our investors, although it is really a natural derivation of a number of existing property investment types. Perhaps you could explain the asset class itself and how it came into being an asset class in its own right.
Yeah, absolutely, Brad. There's a lot of, I suppose, different definitions when it comes to co-living, but at its core, it's communal living. That's what co-living is short for, and it's essentially a furnished studio with shared amenity and utilities in a building which is accommodating a group of unrelated people. They're usually buildings of about 20 or more studios, and they're professionally managed. There's an on-site presence, and they generally have quite a strong focus around community. In terms of the studios themselves, they're all self-contained. They're about 25 square meters each. They've got, cooking area, sleeping area, private bathroom, lounge area, sometimes an outdoor area as well. And so that is, you might think that's a small private area being only 25 square meters. But there's also communal areas, which is the shared component. And that's a much larger area, which is for all residents. And that'll be your larger chef's kitchen for when you're cooking something a bit larger. It'll be a co-working area, lounge areas, and outdoor areas. But co-living, it's essentially housing that was designed and operated for people that would otherwise be living with roommates, and we try to make it better by providing them with convenience, community, and flexibility, and that's how we're adding value for them.
Excellent. Whilst we take a quick break before the next question, I'll just remind all the listeners or watchers on the webinar that there is a poll for questions and whatnot that we can get to either after the webinar completes or offline, depending on what the nature of the question. So next up, so thanks for that, Matt. Could you please now tell us a little bit about UKO, their projects, history, and what UKO look for in a project of this co-living nature?
Yeah, so we're a property management company that specialises in designing and operating co-living and build to rent. Our company started back in 2002 when it was one single furnished apartment in Bondi. It's now grown to about 51 assets across Australia, which is kind of made up of hotels, serviced apartments, co-living, as well as build to rent. If we're focusing, just on the co-living itself, we launched the first co-living building, which was in Sydney, and that was in 2018. So that was the first building in Australia. And we've now got about 26 buildings which we're managing, and there's a couple more under construction. In terms of what we're looking for in a project, we're seeing probably about 6 or 7 of these sites per week across Australia. And so that's given us a bit of an understanding about where are the areas where co-living works and where doesn't it works. We've got a bit of a framework now, and it's comes down to location, demographics, and rental market. For location, the main thing that we're looking for is there strong employment there? And it sounds simplistic, but generally what we like to do is just, if there's a lot of white sheds in an area, that's generally a pretty good indicator that there's going to be strong employment in that area. On location, we're looking for access to transport infrastructure, train station, key arterial roads. We're looking for amenity as well. So is the place livable? On the demographics, where we have modeled our portfolio, so we know what the residents look like in a demographic sense. They're generally aged around the 30 mark or early 30s. So for demographics, we're looking for a high proportion of people aged between 20 and 39. A high amount of single and group households as well. Then we're also looking at how likely they are to rent. Then lastly, we're looking at the rental market. So we want there to be a pretty tight vacancy rate. We want there to be stable rental growth in the area. And we also want to understand how quickly that rental market is moving.
Yeah, brilliant. And I guess that leads me into the next question of, what's the demand for co-living and what attracted you to our Morningside opportunity in particular?
Yeah, it probably sounds like co-living is a bit of a new thing at the moment, but I think it's been around for a lot longer than people realize. I think the reason why it's making headlines at the moment and it seems like it's a trend, it's because probably the way that people are living has really shifted most recently. So I mean, at a very high level, people are getting married a lot later than they used to. I think in 1960, the average age was about 20, whereas it's now 30. People are living with roommates for longer and later into their lives. Wages have stagnated and rents are growing still. So there's a continuing gap that's emerging there. Workplace, this is probably since COVID, workplace practices changing. So there's a lot more flexibility around the ability to work remotely. So that's increased the demand for flexible living arrangements as well. In terms of why we like Morningside, I think it ticks a lot of the boxes which I mentioned just a moment ago. So location-wise, it's got the white sheds, it's got amenity nearby, it's very immediate access to transport. Looking at the demographics, its median age is about 34, 35 years old. 37% of Morningside are either living in single person or group households. And then you've got close to 50% of that market are actually renting themselves, which is, to put into perspective, the Queensland average is about 30, 33%. When we look at the local rental market there, vacancy rates are 1.1%. They say that rental equilibrium should be about 3%. So we've got a very undersupplied rental market. In the last 3 years alone, you look at the average rental growth in the area, and rents have grown about 12.5% on average in Morningside. The last thing we looked at was how quickly the rental market is moving. And so we can see that around 80% of rental listings in Morningside, they're being absorbed by the market within 30 days. So
wow,
there's stock on the market and it's moving quickly. And so those are really the key indicators that give us a lot of confidence in a co-living product in that area.
Yeah, I mean that's a big point, and I think the white sheds is always something that's resonated greatly since we started this journey. And we looked at this site quite some time ago, looking how to solve the rental crisis, but also looking to also solve the fact that apartment buildings in their I guess normal term just can't stack up because of the cost of construction, with building apartments with all that extra area. So, mate, thanks, Matt. That's been very insightful. Perhaps we now turn to David, and he'll give us an outline of why we identified and put the project under control, the opportunity for investors, and the model for the project, which I guess started to allude to in ending up the chat with Matt there.
Yeah, thanks, Brad. So VentureCrowd identified this opportunity in early 24. We had been on the lookout, knowing of the incredible demand, for this co-living product in the market. We had identified that co-living actually has some serious advantages over build to rent. It's cheaper to produce. You've got more bodies per square metre paying paying rent. You're not building a large lounge room for two people for every apartment that you've got and things like that. We can also look at it in building it in a modular fashion, a bit more like student accommodation. So in many respects, it kind of looks as an asset type, a little bit more, almost more like student accommodation than built to rent. So, one of the other great advantages is you've got shorter lease terms. Often it's people, moving to Queensland who are looking to get into a particular area but can't yet get an established house with a 12-month or 6-month rental. There are people who are refurbishing houses who have to be out of it for 3 or 4 months while they do it. And they're key workers too who, would look to this in the medium long term. So Morningside for us as well, met a lot of those criteria. We worked quietly off market to secure the opportunity next to Morningside Station. It had an approval for a hotel, but the opportunity had collapsed with COVID in 2020. The great advantage of this was that the approval that they had got is very similar to the approval that we wanted. So we're able to put our foot on the opportunity and go to council requesting effectively a minor change. So we're not looking to increase car parking. We're not looking to increase bulk and scale. And so we're in the throes of that, let's call it change to the existing development application. And we expect that to come out imminently and for it to be a comparatively seamless transaction. The strategy itself is to utilise the 1.5 million that we're after to get those approvals, to pay all of the consultants, and to do a deal with UKO and put effectively the package to the market. So the opportunity is that within the 12-month period from the initial start, investors would get a return from us selling the land at a profit. There's a number of avenues in which we can, get out of the opportunity here. We can package it up and sell it to somebody who wants to build and own co-living themselves. Some mandates, institutional mandates, don't have a kind of development risk involved, and they'll want us to take that, and we can take that, and we can deliver it all the way through. So as part of that, and as part of shoring up all the required due diligence, we're speaking to builders on it in terms of being able to put a robust belts and braces around the entirety of the feasibility all the way through to the end development, even though in all cases we plan to get out by selling the land into another entity. Yep. So as you will see in the IM, the target sale price is there at 7.5 million. The land we got in at 4.35 million, with the equity at 1.5 and an equity return of around 450,000, depending on when investors get in. With that 30% return, VentureCrowd gets a smallish profit out of that. And in terms of the fact, if we sell the land for even a little bit less than forecast, it's our profit that is at risk first. So investors, I think, can have some confidence in terms of that. So we're putting our profit on the line first.
Absolutely. Thanks, Dave. Yeah, I guess, we were talking about this in the office over the past couple of weeks, that there's been a big swing from co-living as an investment class vis-a-vis office property. And obviously one of the major advantages is around vacancy over the long term. Stabilised co-living operates in mid 90% occupancy over its term, whereas a commercial office building may lose its 1 tenant after 5 years, meaning a releasing campaign, nil rental for the time of vacancy, plus a brand new incentive up to 30% on a lease term. So there's some pretty big advantages here with the fact that rents are locked in for the term for 7 to 10 years, and 3% lower than the current rate of inflation. So it's pretty impressive. And I think since 2020, there's been a flood of capital into the sector. We operate. So just for you again, Matt. So I think you were going.
Yeah, I was going to just jump in there.
Yep.
Kind of expanding on what you guys were just saying. I suppose what we've been seeing out there, and how much it's changed in recent years. I think around probably 2020, maybe even 2021, is where we started noticing things changing. This was always been, I mean, we operate facilities on behalf of everyone. We own nothing ourselves, so we're operating purely as a third party operator. Our clients are typically their private developers, their family offices, their institutional capital as well. Going back before 2020, 2021, this asset class was always dominated by private developers. What's changed is now that there's more awareness about what co-living is, there's more institutional capital that are entering the sector, and they're seeing it almost quite similar, I suppose, as build to rent. They're seeing the returns that are being generated. They're seeing what's happening with the rental market. And so they're really seeing an opportunity there, particularly with the low risk profile that it represents. To go on to what you were saying before, if you've got an office building and you have one office tenant and you lose your tenant, you lose 100% of your income. Whereas if you've got a co-living building and you lose a tenant, it's not the end of the world, and there's plenty more tenants that'll be lining up around the corner to fill that spot. To mention, a few of the groups that we're seeing entering into this space, a lot of it is not public yet and it's behind closed doors. So I can't really speak about too many of them, but among the groups that have come out publicly, you've got Mirvac stating their intentions. You've got Pro-Invest saying that they're going for a portfolio of around 2,000 studios. PGAM, they've got seed assets underway at Parramatta as well as Fortitude Valley. So I guess what I'm trying to say is you're in good company. There's plenty of big groups out there.
Exciting times for a change in the, I guess, the face of traditional property development.
Yeah, absolutely.
Well, guys, I think that's probably everything we've got to say. Unless anyone's got some other points they want to touch on. I guess as part of the wrap up, the offer, go back to that. It's equity to obtain the development approvals for the co-living opportunity at Morningside. Our aim is to ultimately sell the opportunity to an investor, and the investment to investors on the DA phase is returned on the sale of the land. This investment opportunity is open to everyone, and you can invest from $25,000. Again, I'll ask you if we can go to the poll and respond to that.
An attendee has asked, is there a detailed feasibility for prospective investors? So I'm happy to answer that. So we have a detailed feasibility in terms of the expenditure to get to DA, and then we have a detailed feasibility which we've used to work up the opportunity so that we understand that what we're selling the land for to return our profit and the return to investors is robust. And we've also had a third party valuer take a look and validate that. So effectively, that's the answer to that question.
Yeah, I was going to say, there's a preeminent national or international expert in the co-living build-to-rent space who has analysed this behind the scenes using the information that UKO have provided with their rental forecasts and income projections. So I see another question. Who does VC see as a potential buyer, and how long do we think this will take? Look, we had a meeting earlier this morning with another international real estate firm looking at exactly this. Look, it's probably premature to speculate, but their attitude was the quicker we can get this packaged up, the quicker we can sell it, and they're very confident that there are buyers lining up for this class of assets in the marketplace right this second.
Yeah, and I think Matt kind of touched on who some of those buyers are. He mentioned Mirvac, Pro-Invest and PGIM, and certainly they're on the list, and there are, probably kind of quadruple that number that are in the marketplace. And as Matt says, some of them are operating behind the scenes a little bit at the moment. We are seeing some high net worth individuals as well who are big enough and ugly enough to take this kind of asset as well as a long-term kind of income stream, intergenerational income stream for themselves and their families as well. So we're probably just at that sweet spot where we can probably touch, both of those classes of investors.
Another question has popped up in the poll. Are we open to investors from overseas, or does it need to be done by local investors? That's probably one that I'd get the capital team to handle. That's out of our property realm for international investment taxation legislation. So we'll pass that one on for later. And what happens if it takes longer than 12 months to sell? What will happen to the fund and the investors' funds? So
Sure. Well, the 30% annualized interest rate remains payable. So if it does take, for instance, a month or two longer, that 30% would still apply on an annualized basis. So, but, you know, we've got some burning platforms in terms of when we're supposed to buy the land, which is in March next year. So we don't want to buy the land, of course. We want to be selling that on to the end investor. And the reason end investors like that kind of transaction is for stamp duty purposes. If we build the entire asset for them, and it's, for example, $50 million, they'll pay stamp duty on $50 million. Whereas if we sell the land to them at our projected, $7.5 million, they'll pay stamps on 7.5. And then either we or they can deliver it for themselves, and they don't pay stamp duty on the delivery part of that. So it's what they call a fund through. It's a well-known transaction. It's been used particularly for commercial buildings for a very, very long time because of the stamp duty effectiveness of it. So
10 million for land or 100 million for the asset, there's a big difference in the stamp duty. So in this case, 7.5 versus 40 or $50 million for the asset still makes a big difference. So, okay.
I just noticed from one of our capital team, Greg, who was able to answer the question previously, we're open to international investors. So by all means, please do call. And if you look at the VentureCrowd website, Greg King is probably the one to call, in fact. So by all means, put a note in there, and Greg will be onto you.
Yeah. Another question just popped up from an anonymous attendee. Why no access to traditional debt? How come VC equity? And that's a pretty simple one, Dave.
Yep. Well, we've got the land under option. We don't own it, therefore we don't have to put debt on it at the moment. So the idea is for us to be able to do all of this, to package it up, and then to sell our option, which has a contract to buy the land in March, on to the end investor. And it's that end investor who might choose to utilise its own equity, or it might choose to put some debt on the land or what have you. But we're not beholden to do that at the moment. So what we're doing is a transaction that is effectively the most efficient that you can do in the marketplace.
And probably fair to say the most risk-free compared to buying a block of land, subject to obtaining the DA, even though they've got the existing approvals in the background. That was obviously what gave us confidence to march forward and sign the option.
Yeah, so just for example, if we were buying, if we'd had to buy the land up front, apart from the risk of holding the land, if we had, just to use broad figures, got 50% of debt on the land, and we had to use 50% of equity, we would be kind of $2.5 million of equity plus the 1.5 we need to get the approvals. So we'd be raising a lot more equity and applying the debt to the land to be able to do this transaction. So that's the kind of difference in the efficiency that we're talking about.
Yep. Great, thanks, Dave. I think there's no more questions on the Q&A, and the poll is still running. So once again, thank you to Matt and David and all of those that have attended. I hope you've found the webinar helpful. Again, just like you to refer you back to the website if you wish to take an investment in the Morningside Opportunity. There's an initial target of 1.5 million, and we are currently, as of 4:30 this afternoon, 28% subscribed after only 9 days. We'll be sending you a copy of this webinar. You can also post any questions on the deal page that will be answered by our team or the company, and feel free to call us on 1300 039 655 if you have any questions whatsoever. Thank you all, and have a great evening.